You've got this economist view of things next year, that growth is going to be tidy, it's going to be decent, it's going to be fine. Then you've got this market participant worry about downside risk to growth and upside risk to inflation. How did the balance of risks around both those issues, inflation and growth, reconcile through next year? What are you expecting to see?
It's challenging for investors, right? Because they're hearing a lot of things out there, and words like stagflation, I think, do worry people. But at the end of the day, I'll tell you what I'm seeing. People are not taking down too much of their risk. They want to be long. They view some of these headlines as a 1 quarter, 2 quarter impact, especially as it relates to Delta variant. And they want to be there for the growth that we expect next year. So what I've been seeing are people just adding a little bit of hedges on the side to make sure their portfolio is a little more balanced than it was maybe a year ago when it was all risk on. But I don't see people overly concerned and taking down significant amounts of risk.
Monica, how are they hedging? What are they doing?
When volatility comes in a bit, we see a lot of people just adding to put spreads, just very basic things like that. Because again, they don't want to get out of their longs. So a little bit of shorting on the side, it's still inexpensive to do that. And then some put spreads. I will also say I continue to see a ton of interest in plays around interest rates. So if you have, say, a portfolio that's heavy tech, people will say, give me some exposure in case rates do move meaningfully higher. That's one, maybe interesting speculative bet, but two, also a good hedge to a sector like tech that is more rate sensitive from a valuation standpoint.